Your entry timing could be the weakest link in your plan, but you can fix this easily. Here are some proven entry models that work no matter the market or strategy. Engulfing candles at supply or demand levels work because they show you what matters: control. Price moves to a key level, then prints a candle that fully covers the previous bar. For a bullish entry, a big green candle eats a red one. For a bearish entry, a big red candle swallows a green one. This shows a shift in control. So why does this entry model work? It's simple. Markets move because buyers and sellers fight for control. When price hits a supply or demand level, everyone watches, waiting for a side to get on top. The engulfing candle answers that question in real time. In a bullish engulfing, the green candle tells you buyers didn't just show up, they overpowered the sellers and erased all the selling from the last candle and more. Also, a supply or demand level isn't just a random price. It's where lots of trades happened before. It's where people expect a fight. So when an engulfing candle forms there, you're not just seeing a candle, you're seeing the outcome of all that pressure. The sellers in this case didn't just win, they crushed the other side and made it clear who's driving now. This entry works because it's based on what's happening right now. You don't need to predict, you just react. When the candle closes, you enter your trade. That's your signal. You're not jumping in early, you're not chasing. You're waiting for proof that the shift already happened. Waiting for the close of the engulfing candle is important. This keeps things simple. You don't have to scroll through lower timeframes or set up complicated triggers. You just wait for the candle to finish. If it's a bullish engulfing, you buy at the close. If it's bearish, you sell at the close. This entry method also gives you a clear place to set your stop. The low of the engulfing candle for longs and the high for shorts. The beauty of this entry model is its simplicity. You aren't lost in a sea of lines or setups. You watch for price to test a level, see who wins, and act on the proof. The engulfing candle is your go signal. This keeps you from chasing moves or getting caught in weak levels. Support and resistance flip is one of the simplest, clearest, most dependable entry models you'll ever see. It's about seeing the moment when the crowd changes its mind. So picture what happens in a strong uptrend. Price keeps pushing higher and reaches a resistance area. Sellers try to stop the move here. You may see price bounce down a few times, but each bounce is weaker. Then price finally breaks through resistance. And after the breakout, price doesn't just run non-stop, it often pulls back. The same thing happens in reverse in a downtrend. Price falls through a support level and sellers win. Price keeps dropping, but then curls back up to test the same area. And now the old support acts like a ceiling. But why does this flip work? It's about how traders get trapped and how big players fill their orders. When price breaks out, many traders are watching the old resistance. Some sold short there, others waited to buy until after the breakout. When price pulls back, those who sold want to get out with a small loss, so they buy back at the new support. New buyers who missed the breakout also enter on the pullback. Big traders use this spot to fill large buy orders without moving the price too much. The flip is where old sellers turn into new buyers. It's the same for support turning into resistance. Old buyers flip to sellers. You want to enter at the flip, not at the first breakout. You know that breakouts can be tricky. They often fail, with price snapping back into the range and trapping traders. But when price breaks out, pulls back, and holds at the flip, you see real strength. The market is showing which side is in control. This is your entry spot. And a real flip zone is usually wide, not a thin line. The reality is that markets are messy. Sometimes price will poke just past the level, then turn. Sometimes it will fall short. So draw your support and resistance as bands, not razor-thin lines. This helps you see where the action really is. If you wait for a perfect touch every time, you'll miss the best trades. The first retest is usually the strongest. After the initial breakout, the first time price comes back to test the flipped level, the reaction is often fast and clear. Later retest can still work, but the edge is strongest on the first or second touch. The more times a level gets tested, the weaker it becomes. The more obvious the level, the more traders are watching, and the stronger the reaction when the flip happens. First pullback after a market structure shift is another proven and effective entry. Imagine you spot price going down for days. Suddenly, it flips. It breaks a recent high, showing buyers finally took control. That's a market structure shift. Most new traders rush in right there, scared to miss the move. But the first move after a shift is often wild and sharp. It's full of traders bailing out of old trades, stops triggering, and late chasers piling in. If you enter right at the shift, you risk getting caught in this mess. The smarter way is to wait for the first pullback after that shift. Price makes its first move in the new direction, then pauses or retraces, maybe to a moving average, maybe to a previous level. You don't jump in during the noise. You wait for price to slow down, pull back, and then show it's ready to run again. Enter as soon as you see buyers or sellers step back in, and price resumes the new trend. This way, you're not guessing, you're following proof. The market reality is that trends don't go in straight lines. After every strong move, you'll see a counter move, a pullback. In this case, that means a short drop as traders take profits or late sellers try to fight back. But these pullbacks are weaker than the main move. They don't have the power to reverse the trend. Instead, they stall out. The stronger trend steps back in, and price continues. When you trade the first pullback after a market structure shift, you're getting in after the dust settles. The wild emotional part of the reversal is over. Now the market is showing its real direction. You get a clean entry with the trend, not against it. Again, let's break down the entry. Price drops for days, makes a new higher high. Instead of buying right there, you wait. Price pulls back to a demand zone. You watch for signs that selling is drawing up, like smaller candles, lower volume, or even a reversal bar. As soon as price pushes back up, resuming the trend, you buy. Your stop goes below the pullback low. You're in the new trend, but not chasing. This entry method keeps you out of trouble. Right after a market shift, things get choppy. The first push in the new direction is often fast and can snap back just as quick. If you buy the breakout or sell the breakdown, you risk getting trapped when price pulls back. The first pullback gives you a second chance, an entry with less risk and less noise. Trading the first pullback gives you a better risk-to-reward setup. Your stop is close, just under the pullback low for longs, and just above the pullback high for shorts. Your target is the next swing high or low, or even further if the trend keeps running. Because you enter after some profit-taking or counter-trend action, you often get a cheaper price. You're buying low in an uptrend or selling high in a downtrend. The first pullback after a shift repeats itself because price always moves in waves. People buy, take profit, price pulls back, then the next move starts. The next entry model involves liquidity grabs against the main trend. So picture a strong uptrend. Price keeps making higher highs and higher lows. Everyone sees it. Traders want in. They chase price, buying late and putting their stops just below the last swing low or the nearest support. Now think about the big traders, the ones who need a lot of volume to buy. They can't just buy at any price. If they do, they drive the price up before they get enough filled. So they hunt for liquidity. Liquidity is where lots of orders wait to be triggered. In an uptrend, think of all those stop losses sitting just under the last low. That's a pool of sell orders. When price drops into that zone, those stops fire off, and sellers rush in. For the big buyers, this is perfect. They want to buy, and now there's a flood of sell orders to buy from. This is the liquidity grab. Price dips under support, grabs all those stops, fills the big buy orders, and then rockets back up. The trend keeps going. The weak hands are gone, and the big traders are in. That's the setup. So why does this entry work so well? It's all about how the market actually moves. Most retail traders want to buy when price is running up, but that's the worst time to buy. You risk buying the very top, just as price is about to pull back. The liquidity grab flips this around. You don't buy the top. You wait for a sharp drop against the trend, right into the place where everyone else's stops will trigger. That drop is the grab. It scares out traders who bought late and set their stops too close. When they get stopped out, their sell orders fill the big buyers' orders. Once the selling is done, there's no one left to sell. Price snaps back up, and the trend continues. The entry is simple, but it needs patience. You wait for price to drop below a recent low in an uptrend or above a recent high in a downtrend. You know that's where liquidity pools sit. You want to see a quick flush, price slices through, then price snaps right back up. That's your signal. You enter as soon as price comes back above the broken support, or as soon as the candle closes back inside the range. Your stop goes just below the liquidity grab low. You catch the move right as the trend resumes, not after it's already run far away. This entry keeps you out of trouble. Instead of chasing, you wait for price to come to you. You don't get caught buying the top. You don't panic and sell when price flushes down. You know the grab is most likely a trick, a move to shake out weak hands and fill big orders. One big advantage of this entry model is that you get great prices. You're buying near the bottom of the drop, not the top of the run. This means your stop is tight. You can put it as below the grab. Your risk is small, and your reward is big if the trend keeps going. Opening range breakout is a good entry model for fast trades. It takes the chaos of the morning and turns it into a simple, actionable plan. Every morning, markets wake up with a bang. There's a rush of orders, leftover trades from the night before, and new bets for the day ahead. And this chaos sets up one of the simplest, sharpest entries you can use, the opening range breakout. You start by watching the first stretch after the open, maybe 5, 15, or 30 minutes. You mark the highest point and the lowest point price reaches in that window. That's your opening range. It's like drawing two lines on a field. Above is buyers win, below is sellers win. But you don't trade yet. You wait. The market is in a fight and you want to see who wins. Once the opening range is set, you watch for a clean break above or below. A breakout tells you that one side just overpowered the other. If price breaks decisively above the range, buyers win. If price breaks below, sellers take control. The breakout isn't just a random move, it's often the start of a strong trend for the rest of the day. That's why you enter with a break, riding the momentum right as it starts. The entry itself is simple. Set your lines at the high and low of the opening period. As soon as price breaks out and trades in the new zone, you enter in that direction. You're in right at the start of the move, when momentum is strongest. One big advantage, the opening range breakout gives you a clear mechanical entry. You know exactly where to act. The line is drawn, and as soon as price consolidates above or below it, you go. This keeps you from hesitating or getting stuck in indecision. With a clean break, you get in early, right as the crowd moves together. Another edge, The opening range gives you built-in risk management. Your stop goes at the opposite side of the range. If you enter on a break above the high, your stop is at the low. If you go short on a break below, your stop is at the high. This means your risk is defined from the start. You know how much you could lose before you even enter. There are also downsides. The biggest risk is the false breakout. Sometimes price pokes above the high or below the low, only to snap right back into the range. This fake out can trap you, forcing a quick loss. That's why opening range breakouts don't work every single time. Some days, you get trapped and stopped out quickly. Another challenge: breakouts fail more often when the opening range is unclear or choppy. If the first candles are wild and overlapping, with no clear direction, you're more likely to get faked out. On those days, it's better to skip the trade than force an entry. So only act when the range is clean and price action is decisive. Pivot point bounce is a classic entry, one of my favorite models. You simply mark the main daily or weekly pivot levels. These lines are not magic, but they matter. Price reacts to them again and again. That's because many traders, big and small, watch the same levels. Their orders cluster there. That makes pivots like magnets, pulling price in, then sometimes flipping it away fast. This entry model works because pivots show where trades might pile up. When price moves into a pivot, it's like a test. Will it smash through or bounce off? You don't try to guess before it happens. You wait for price to hit the pivot, then watch for a reaction. If price wicks hard, prints a reversal bar, or bounces back with energy, that's your signal. You enter in the direction of the move, away from the pivot. The entry gets even better with the pivot's direction. If today's main pivot sits above yesterday's, it shows buyers control the market. You look for long trades. Buy when price bounces up off the pivot. If the pivot is lower than yesterday's, sellers have the edge. So you look for shorts. Sell when price bounces down. This keeps you trading with the bigger trend, not against it. This entry model gives you a clear plan. You know where to look. You know when to act. There's no guesswork. The pivot keeps you focused. You avoid chasing price. You don't have to stare at dozens of indicators. You just mark your pivots, wait for price to come to you, then watch for the reaction. This model repeats day after day. Pivots give you built-in risk control. If you enter on a bounce, your stop is close, just on the other side of the pivot. That keeps your losses small if you're wrong. If the bounce holds, price can run far, giving you a strong reward compared to your risk. This makes the setup clean and efficient. Timing also matters. Pivots work best when the market is active, at the open, during big sessions, or when volume is strong. In slow times, the bounce can be weak or fizzle out fast. So watching volume and timing helps you avoid weak trades. Snapback from overextended move is a high-risk, high-reward entry. Price can run far in one direction, sometimes too far. You see this in big moves that stretch past normal ranges, break out of channels, or push beyond VWAP bands. At some point, it has to slow down or turn back. These are overextended moves. When everyone chases the move, price often gets pushed way past what's normal. This is when aggressive traders watch for a snapback. Now, why does this entry work? Well, big moves attract attention. Traders jump in, hoping the momentum will keep going. But the more extended the move gets, the more likely it is to snap back. There's a point where buyers or sellers get exhausted. No one left to push price further. You see the signs: a reversal candle, a big wick, or a sudden spike in volume. They show exhaustion. When price snaps back inside the band or channel range, that's the entry. You're betting that price will return closer to its average, not keep running forever. This is called mean reversion. Price usually moves around an average. When it goes too far from that average, it often comes back. The snapback entry takes advantage of this. You wait for the crowd to push price to the extreme, then enter when you see the first sign of reversal. The entry itself is sharp. You don't guess where the top or bottom is. You watch for price to move far outside the normal band, maybe outside a channel, past VWAP lines, or way above the average range. You wait for exhaustion, a candle with a long wick and a sudden spike in volume. As soon as price snaps back inside the band, you enter. Your stop goes just past the extreme. This setup works because markets move in cycles. Big trends get overdone. When they stretch too far, the move becomes unstable. Weak hands jump in late, hoping for more, but smart traders know the risk is now high. Profit-taking or stop losses trigger, and price snaps back fast. Because you enter close to the extreme, your stop is tight. Your risk is small, but your reward can be big if price returns to the average or further. Because you enter close to the extreme, your stop is tight. Your risk is small, but your reward can be big if price returns to the average or further. But this model isn't easy. The biggest risk is trying to call the top or bottom too soon. A lot of times price will go further than you think, blowing past your levels and stopping you out. And that's okay, because this entry model works on high reward ratios. Even if you catch 1 out of 3 reversals, you will still be in profit. This entry is not for everyone. It's tailored for aggressive traders. You're going against the current trend, stepping in as the crowd is still pushing. That takes nerve. There's always the chance the move keeps going, and you're caught fading a trend that isn't finished. That's why waiting for clear exhaustion is key. Range expansion after compression is a sharp entry because it's built on pure price action. Price moves in waves. Sometimes it runs fast and wild. Other times it gets stuck, moving in a tiny box. This is compression. The market is resting. And this is a clue. Something big is coming. Compression shows up as a tight range, candles with small bodies, and no one really winning. Buyers and sellers both wait. Volume drops, and the chart goes quiet. But underneath, pressure builds. Orders stack up on both sides. Traders get bored, impatient, or even trapped. The longer the compression, the bigger the pressure. You don't jump in during this quiet period. Most trades fail here. Price chops sideways and fakeouts happen. You let the compression build, so you mark the top and bottom of this zone. Now comes the entry. You wait for the breakout, a big candle, strong volume. Price bursts out of the tight box. The expansion must be sudden and sharp. This is the moment you enter, right as the market wakes up. Now why does this work? Compression is like a market inhale. The move after, the range expansion, is the exhale. All the orders that built up during compression get triggered at once. Stops fire, breakout traders rush in, trapped traders bail out, volume explodes. The first move out of compression is often the cleanest, fastest move. You catch that burst by entering right as price expands. This setup works because it focuses on timing. Most traders get chopped up in noisy markets, entering too soon or too late. Compression gives you a clear signal. The entry is simple. Mark the high and low of the compression zone. As soon as price breaks out with a strong candle and increased volume, you enter in the direction of the move. You're in right as the market shows its hand. You get more than just a good entry. You get a built-in stop. If you go long on a breakout up, your stop goes just inside the compression zone. If you go short on a breakdown, your stop goes just above the range. This keeps your risk tight and your reward open. The move after compression often runs far, giving you a strong risk to reward setup. This model also filters out bad trades. If price never breaks out, you don't enter. If the breakout is weak, like a small candle and no volume, again, you skip it. Only the clean, strong expansions get your trade. This entry model works because it's rooted in how markets build energy and release it. The first move out of compression is your chance to jump in before the crowd, with a plan and with purpose. You set your lines, wait for the squeeze, then enter only when price breaks out for real. You keep your stop tight, your entry clear, and your edge simple. Now, if you're ready for more interesting trading guides, go ahead and watch one of these videos next.